Hi, this is Diana Sescolini, and we're going to be talking about Chapter 9, which involves long-term assets, fixed and intangible. So these long-term assets are things that you normally buy to generate you more revenue. Matter of fact, this is the only reason you buy a fixed asset. They're usually things such as equipment, machinery, buildings, and land. So they have different names for fixed assets. They're also called property, plant, and equipment, or plant assets, or long-term assets. So there's four names for the same thing: fixed assets, property, plant, and equipment, plant assets, or long-term assets. And the characteristic of understanding what a fixed asset is that they physically exist. In other words, they're tangible assets. They're owned by the business and they're used in a normal productive manner. For example, if I was a delivery company where I had made deliveries and I bought a small pickup truck, that would be used for deliveries. Okay, and the last characteristic is they're never offered for sale. So again, if I'm a delivery service business and I buy a small pickup truck, that would be a fixed asset. However, if I'm a delivery service and I buy a racehorse, that would not be a fixed asset for me. That would be an investment. We'll talk about that a little bit later. So just make sure you understand that the characteristics of a fixed asset are. Before we start talking about this chapter, we're going to have to understand how to classify all costs. So I basically need to learn how to understand which cost belongs where. Does it go to a fixed asset? Is it an investment such as that racehorse, or is it just an expense? And there's a little flow chart for you to help you understand this information. In order to understand how to classify cost, you're going to ask yourself two questions. Is the purchase item long-lived? In other words, can I use it for longer than a year? That's usually the key. If it's yes, it's either a fixed asset or investment. If it's no, it's an expense. So this would be a perfect example for my delivery service business. If I was buying oil to maintain my vehicles with, that would be considered an expense. So if you say yes, you're going to move to step two. Step two says, do I use this in my normal operations? So if yes, it is a fixed asset. That's why that vehicle I buy would be a fixed asset. But if no, it's an investment. That's why that racehorse would be an investment. So here's a little flow chart to help you understand that. So you just need to understand how to classify costs, because in here we're going to talk about the cost of fixed assets. And I want to make sure that we include all the cost in there. When I taught you information in the first few chapters, we just talked about the cost of the building. The cost of the equipment is what you put down. But now we're going to talk about other costs also. We're going to talk about cost of the building, the machinery, the equipment, and the land. So here's some examples. So the building, this is the building cost. This is if I build a building. But let's go here to machinery and equipment. Now in chapter 1, I believe it was, I taught you that basically when I buy a piece of equipment, I put down the cost that I pay for it. But now there are other costs involved that I have to look into. Did I pay sales tax, freight, installation, insurance while in transit? Did I have to have somebody come in and assemble it? So all of these costs will go into the cost of the fixed asset. All of these costs would go into or increase the cost of the building that I'm building. The land, if I buy land. Now, by the way, this chapter is about depreciation. And we learned that in chapter 3 when we were doing adjusting entries. However, land is the only fixed asset that does not depreciate. But there is something called land improvements. And so if I buy a piece of land, I build a building there, a factory, I still need to put fences, I need to put outdoor lighting, I need to pay the parking area. All of that is actually the cost of the land improvement. So we need to understand in this chapter what exactly is the cost of the fixed asset. Now these are things that are not cost of fixed asset. Vandalism, if I decide to install it instead of paying somebody and I make a mistake. If I damage it when I unpack it. Any of these things are not cost of fixed assets. They become expenses. This chapter is about accounting for depreciation. We learned it in chapter 3 when we were doing adjusting entries. Depreciation is basically recording the asset itself and how it no longer has the same value because of physical and functional factors. So we're going to talk about depreciation. And the most important thing in this chapter is understanding what is the cost, what is the book value. We're going to talk about that, and how to calculate the depreciation. Here we're going to talk about how to calculate depreciation, and there'll be a few different ways that we'll talk about. So the book value, and I don't remember if you remember that, the book value is the cost of the fixed asset minus the accumulated depreciation. So we need to remember that. The book value is the cost minus whatever's in the accumulated depreciation. And just to refresh your memory, accumulated depreciation is a contra asset account. It subtracts from the value of the equipment. So let's get started in calculating depreciation. We're going to have 3 different methods, and I'm going to go over all of them, but there are 3 very important pieces of information that you need in order to do this. You need to know what is the initial cost or the total cost of the asset. That would include all of the shipping, the sales tax, the installation, the cost we've just seen on the actual first few slides. Then I need to know what is the asset's expected useful life. And finally, the residual value. So I'll explain each of these on the next few slides. So again, the initial cost is the fixed asset, the price you paid for it, plus any cost that you incurred getting it ready to be used. The expected useful life is basically determined by the government. It's placed into business, and its useful life can be anywhere from 3 years to 29 years, depending on what type of thing it is. Different categories exist on that. So for example, a piece of equipment has a 7-year useful life. That truck that I might have bought for my delivery service business would have a 5-year useful life. Computer equipment's 3 years useful life because of obsolescence and technology changes. So the useful life is actually normally determined by the IRS in real life. And so we're going to use the useful life. Now, that delivery truck I bought, just because it has a 5-year useful life, it doesn't mean that after 5 years I can't use it. It just means I can no longer depreciate it on my books. So think of depreciation as a well, we're going to talk about, it's basically I'm recouping the cost that I paid. So whatever I paid for that truck, I'm going to recoup the cost over 5 years via depreciation. So depreciation is a non-cash expense because I don't get money back for it, but I get a tax deduction for it. I'm jumping ahead a little bit. Okay, so the last thing on our list was residual value. The residual value, think of it as what can I trade it in for at the end of its useful life. So the residual value is the value of the asset at the end of its life. A delivery vehicle, 5 years old. How would I determine the residual value? I would use something like Kelley Blue Book to figure that out. So all we need to understand is what is the value of it at the end of its useful life. And so we're going to find the difference between the cost and the residual value, and I'm going to explain the formula pretty soon. So that's called the depreciable cost. The cost minus residual value is called the depreciable cost. If I have no residual value, and by the way, the residual value is the only one of the 3 things that actually you determine. The cost is what you pay for it. The useful life is what the IRS says, but the residual value is the only thing that you actually have control over. So we're going to show you an example. Here's the cost of a piece of equipment that I bought, $24,000. Its useful life is 5 years, and estimated residual value is $2,000. So remember, my depreciable cost will be 24,000 minus 2,000. So that'll be 22,000, and then I'm going to spread that over 5 years. So my depreciable cost is 22,000, and then I'm going to take an expense for 5 years. So this is just a summary of understanding how depreciation works and how depreciation expense works. Next, we're going to be talking about the 3 different methods on the next videos.